I suppose the property sells paper, and I must say that every video I've put on the subject of property, which is 99% of my videos, have had more views than the 1% that talk about something else that may well be more important than the property, like bond market and stock market. But in this short video, I want to read you an article that was pointed out to me by one of the subscribers. And I don't read the main, especially commercial newspapers, because again, property sells it. But nevertheless, I'm going to read you this article and also play the video on this article. That whoosh it's the greatest Chinese property pullback. So that whoosh you just heard is the Chinese money pulling back from the property in London to Sydney to New York. Capital centers globally should brace for tumbling real estate prices as Beijing manages to do what Brexit and high interest rates haven't. We haven't seen the high interest rates, by the way. Reflecting tighter regulations, China overseas direct property investment could drop 84% to 1.7 billion US dollars, which is 2.15 Australian dollars this year, and about another 15% to 1.4 billion US dollars in 2018, according to Morgan Stanley, another mainstream house. Thank you. Mainland money began piling into offshore commercial property in 2013. Land prices were expensive at home, and investors wanted to find a hedge against the weakening yuan. Another draw was the prospect of higher returns in cities such as Sydney, where yield spreads, the difference between rental yields and what government bonds pay, are higher. A slumping British pound post-June 2016's Brexit vote helped as well. While some marquee transactions are still being inked, think the purchase earlier this year of London's cheese grater tower by Chongqing-based Hong Kong-listed CC Land Holdings. Their numbers are dwindling. Strengthening yuan, along with China's One Belt, One Road initiative that needs funding, will see many property deals dry up. Over the past few months, Beijing has made it tougher to get money out, clamped down on more financial transactions such as buying of football clubs and luxury hotels, and is now going after some of the country's most prolific acquirers. Dalian Wanda Group, Nbang Insurance Group, HNA Group, and Fosun International have all included real estate in their global buying binges. Against that backdrop, and with increasing foreign government scrutiny thrown into the mix, it's hard to see how Chinese offshore real estate acquisitions can continue at such a pace. Domestic developers are already finding it harder to tap international debt markets and have been resorting to short-term securities instead. This matters because Chinese capital accounted for 1/4 of commercial property transactions in central London last year, up from 1% a decade ago. China is now the second largest foreign investor in the US after Canada, and is responsible for between 12 and 25% of all office transactions by value in Australia over the past 2 to 3 years. In Hong Kong, Chinese firms have bought about 80% of the residential land sold so far in 2017, and have spent around 6.5 billion US dollars on office space from 2012 through 2016. One sliver of good news: some Chinese companies have capital already stashed offshore with which they can keep buying, plus there are other interested Asian parties around. London's walkie-talkie tower was sold last month to Hong Kong's LKK Health Product Group, and Sunac China Holdings, now the most indebted developer, after buying assets from Dylan Wonder Group, last week issued $1 billion bonds. Whatever, that's enough to offset the amount of money going the other way, however, is questionable. Whether that's enough to offset the amount of money going the other way, however, is questionable. Investors would be wise to stand well back. Alright, sorry about that, I probably need another coffee, it's only 6 o'clock in the morning. This is the video I just want to play for you.
It's almost 10 years since the global financial crisis. In June 2007, the public downfall of New York-based global investment bank Bear Stearns began. America's then fifth largest investment bank was among a number of Wall Street giants exposed to bad bets on the US subprime mortgage market. Today, the scars of the GFC remain. There's been trillions of dollars in losses, and in a world of subpar economic growth, even the optimists are downbeat. There's 4 core reasons why the recession took place: excessive debt, ineffective regulation, flawed compensation structures that encourage risk-taking, and a lack of accountability. These core problems remain. Last time Australia was able to avoid dipping into recession, now the same fragilities that plunge the world into chaos threaten Australia's economy. What stands out in this mess, though, is that regulators had the opportunity to intervene and put the brakes on this expansion in lending, but the world kept taking on debt. This is why Australia is heading towards a crisis. The most obvious risk to the financial system is public and private debt held throughout the world. In Australia, the main issue is private debt, and that is mainly held by households. Lindsay David, founder of Aleph Economics, has warned of systemic collapse. He says banks have engaged in Ponzi finance schemes that have inflated the cost of housing and over-leveraged average Australians. The tide of regulation may be turning, and not for the better. Globally, there's been many efforts to boost regulations. Banks now have to have higher buffers, and they also have limits on the amount they can lend to people. But experts say that below the surface problems remain, and that overlending is still going on. Current compensation models are built around short-term profits. There's not enough incentives to encourage thinking about the long term. There are concerns bonuses reward banks and financial institutions in taking risk. It was extreme risk-taking that led to an unstable banking sector in the US and eventually the crash. Several studies have analysed consumer borrowing, and it basically comes down to this: people will borrow money if it's available. The average person won't think too critically about the long-term risks associated with taking on large loans. If credit is available for them to buy a home, they'll take it. The availability of credit is what's partially responsible for Melbourne and Sydney's high house prices. The sum of these factors is less stability and more risk. Economists are now in near agreement that Australia's and the world's fate is in danger.